Hello guys, welcome back to Money Talks BS Walks. Roberto here, here in Pixels. I'm trying a new approach of no faces and aiming to do visuals. If not this video, then definitely the next one. So hopefully this is something that I can do in the long run. So today we're going to talk about investment. Now, last week we spoke about stocks and how they work. Now, stocks are definitely one way to build investment income and supplement retirement funds. However, it doesn't really provide an ironclad tight solution as you have all your eggs in one basket. And if that basket just up and goes in flames, then we're in trouble. So that's why we have to talk about diversification, specifically having different streams so that you can always be ready for anything. And this practically means dividing up where you put your investment, which leads to multiplying since many places are increasing simultaneously. So whatever your risk tolerance, one of the best ways to manage risk is to own a variety of different investments. Again, you have to make sure that you don't put all of your eggs in one basket. In the world of investing, this concept is called diversification. And the right level of diversification makes for a successful, well-rounded investment portfolio. So here's how it goes. If stock markets are doing well and increasing, woo, that's great. You're earning money. However, if they're going down, then you're losing money. But on the other hand, if you have multiple eggs in multiple baskets, one basket can essentially be going down in flames and the other one can be staying stable and actually growing. So let's say you are invested in stocks and real estate. Your stocks can decrease, but real estate could very well skyrocket. So all in all, if you were properly diversified across bonds and stock investing or real estate or some other form of asset class, you could limit your losses. And by owning a range of investments in different companies and different asset classes, you can buffer the losses in one area with the gains in another. This keeps your portfolio steadily and safely growing over time. And this is what you want. You want to be able to have coverage. So stocks, real estate, all of this sounds cool, but how do I even start? And the good news is you don't need a ton of capital. Getting started with investing is relatively simple. Here's how to figure it out. What kind of beginner investment account is right for you? So let's say you have a little bit of money to start an account, but you don't want the burden of picking and choosing investments. It's like, no, not me. You might want to start investing with a robo-advisor or somebody that helps you out. These are automated investing platforms that help you invest your money in pre-made diversified portfolios. They're customized for your risk tolerance and they have all these graphs and analytics and financial goals. But as I noted in the previous video, this type of investment is managed and may cost you more than you wanted in order to gain benchmark-esque results. These are not results that are out of the ordinary or to the moon. These are simply arguably traditional. They're stereotypical. It is what it is. So if you prefer hands-on research and chose your investment portfolios that way, you might prefer to open an online brokerage account and handpick your own investments. And if you're a beginner, remember, the easiest diversification that mutual funds and ETFs offer is just simply things like the S&P. Regardless of how you choose to start investing, keep in mind that investing is a long-term endeavor. And I'll say that again. Investing is a long-term endeavor. It's a process. And you'll reap the greatest benefits by consistently investing over time. It ain't a get-rich-quick scheme. You need to stick with an investment strategy, whether markets are up or down. So start investing early and keep investing regularly. Start investing early and keep investing regularly. Regularly investing helps you take advantage of natural market fluctuations. Like, when you invest a consistent amount over time, you buy fewer shares when prices are high and more shares when prices are low. And over time, this may help you pay less on an average per share. This thing is called dollar cost averaging. However, This is only effective if you keep investing no matter what. Like, you can't try to time the market and engage and see when the best time is. A continual drop in the bucket will fill up the bucket. So you should also remember that no investing is guaranteed. And that's cool. Your investments will go down. That's normal. But calculated risks, should you take them, they pay off. And one person that knows this for a fact is Sandy Bragar. She's the managing director at wealth management firm Aspirant. And she notes that this is all about the S&P 500's gauge. She says over the last 30 years, an investment in the S&P 500 would have achieved a 10% annualized return, but missing the 25 best single days during that period. During the last 30 years, the best 25 days, just stop right there. 30 years, 365 days, we talking like a good 10,000 days. You missed 25 of the 10,000 days, you would have only gotten 5% instead of 10. That's half. So this is a reminder not to sell your investing. Do not sell your investments in a panic when the market goes down. It's incredibly hard to predict when stock values will increase again. And some of the biggest days in the stock market gains, it's followed days of large losses. So bear that in mind. It's okay for your account to fluctuate. It's all good, but success will only come through weathering that storm. Finally, the best investing begins by investing in yourself. Learn about the types of retirement accounts that you can acquire and start. Get your emergency savings set up and going. Get your money up, not your funny up. Create a strategy for paying down your student loan debt. If you do all of this stuff, you can start investing with confidence, putting the money you have today to work on securing your future, your tomorrow. Now, with that being said, thank you guys so much for tuning in. We'll be back next week with a new finance topic. But I really want you to really think about this. You have to keep going. You can't grow weary in well-doing, for due season you're going to reap. It's going to be all good, but you can't let your foot off the gas. So, again, my social links are below. Love your support. Would like to see what I should do, how I should improve, and what I need for y'all. But as always, Roberto here. Slay, stay up, and I will see you next time.